Market will never like Mamata Banerjee, and for good reasons. So last week, when it became apparent that the survival of UPA government is no longer conditional on the generosity of Ms. Banerjee, equities confidently climbed past the previous highs to record a new 12-month peak. The question in our mind is whether the runway rise in equity prices is merely in celebration of her exit or for real economic gains. Yes, the UPA government has struck back strongly. Apart from saving the country from an almost certain downgrade, Congress seems to have turned the table politically as well. But in a 24/7 world, the impact may not last unless it is followed up with sustained action. And it makes sense to move quickly. After all, the opposition can't take to streets every week. A new 12-month high for Nifty calls for celebration. However, it's worth pondering whether or not the exuberance is rational. Or in other words, are we at the early stages of a new bull market, or showing symptoms of another false move typically founded on irrational crowd behavior? If it is the former, which we believe is the case, wisdom dictates that the market will consolidate its gains along the way and provide opportunities at every turn to benefit from the trend as it gathers momentum. Last week, Pascal Lamy, Director General of WTO, cut the 2012 growth forecast of world trade from 3.7% to 2.5%, which is less than half of the previous 20-year average. Quite in tandem, the voice of researchers forecasting continuation of slowdown in China is getting stronger. The latest one, from an economist with the Chinese Academy of Social Sciences, predicts China's economic growth slipping below 7% in Q1 of 2013. Economic prospects of US, Europe and Japan remain propped up by large doses of quantitative easing. In fact, by their own admission, most central banks are now very much in unfamiliar territory, since never before they have had to resort to so much of stimulus to prevent economies from imploding. The resultant uneasy calm in financial markets is therefore periodically punctuated by sharp price movements betraying an undercurrent of suppressed anxiety.
If the QE3 in America and LTRO in Europe fail to lift the growth and curb unemployment in foreseeable future, as some predict, recent highs witnessed by most Western markets may come a cropper.
Ironically, last week, China, despite being the growth engine of the world, recorded a 3-year low of Shanghai Composite at 2026, while a number of markets, Dow, S&P, DAX, Nifty, SGX and Nasdaq, recorded new 12-month highs. Apart from the anticipated slowdown, perhaps it's also reflective of the uncertainties associated with the impending regime change in November, when Xi Jinping is expected to replace Hu Jintao. Whatever the reason, it is not comforting to see Shanghai Composite languishing at a 3-year low. Back home, the latest policy moves will neither rescue the fiscal deficit nor induce a flood of FDI in a hurry. Mr. Rangarajan, part of PM's think tank, went on record last week saying India needs FDI of $70 billion to counter this level of fiscal deficit. Therefore, Percentage Play views the latest developments as nothing more than a welcome first step. In the context of deepening shadows on global growth, equities will need to see a turnaround in investment cycle before the bull market can take root. Sector-wise analysis of Nifty doesn't provide an overtly bullish picture. Until the diesel hike and its consequent multiplier effect is fully absorbed, it is difficult to predict whether the resultant inflation level will induce RBI to cut rates in October. Further, the sharp deterioration in asset quality of banks may not allow a quick transmission of rate cuts even if RBI were to relent. Rate-sensitive sectors like banking, auto, cement and infrastructure, constituting 43% of Nifty, may not therefore look entirely promising. With TCS's revised guidance for Q2 sounding somewhat subdued, the tech sector, accounting for 13% weightage, may not provide fresh propulsion, especially with a trend reversal in rupee dollar. The defensives, pharma, consumer plays and telcos have been at the receiving end of sector rotation last week. Any support in future will mostly come from a switchback from rate sensitives. Nifty therefore realistically may not lift off for the moon anytime soon. Drivers next week are several. A meaningful cabinet reshuffle could be a mood lifter, while bulls could hold sway at next week's settlement. Under pressure from Jagan Reddy in Andhra, Congress could smoke the peace pipe with TRS with an announcement on Telangana, and Mr. Chidambaram may close a deal with Vodafone with a negotiated settlement around 8,000 crores by waiving penalty and penal interest. He can also push through much awaited higher cap for FDI in insurance sector. FIIs could continue with their full-throated support by repeating or bettering their performance last week, a net purchase of $1 billion, and who knows, DIIs may finally give up and joined the party after being sellers last week of $540 million. We at Percentage Play believe that odds next week will certainly favor longs. The extent of market move will depend on how quickly Congress can act, both on next set of reforms and activating a moribund bureaucracy. Percentage Play was proud to celebrate a century of winning trades in Quant Pair Fund last week. We wish to also emphasize that these are not just market calls but real trades in our proprietary fund, and we are relishing solid profit ourselves. With this, our win to loss stands at a handsome 81%, and we have earned a return of 20% annualized or 30% since inception. Bearing in mind that this is a low-risk market-neutral fund, the returns are truly remarkable. Our competitive value fund, which is pure equities fund, crossed the milestone of 10% annualized return last week. We continue to outperform the market despite holding on to the discipline of investing only in large-cap, good governance, blue-chip companies. Quant Trading System, which provides our daily call to individual counters, did very well last week, 15 winning trades to 6 losing trades, and a profit of 17,200 at the minimum level of position taking. Please check our running scorecard at the following link. Thank you for watching.